Well, welcome to this week's example that I'm going to do for you. So this week we're going to be looking at income and trust. So I'm going to be doing question 8 for you, which is about the Chan family trust. Now, first off, we're going to do it as discretionary or family trust, and then secondly, we're going to rework it as though it was a deceased estate. Now, through your studies in regards to this topic, it is not an easy topic. I acknowledge that, having to learn about minors and the different types of income they have and the different types of person they might be, being accepted or prescribed, and then the income also being of eligible or acceptable income. We also move on to the trust, calculating the income of the trust, and remembering that the income of the trust is very similar to everything else we've done. It's its assessable income minus allowable deductions of the trust gives it a net income or a net loss. Now, a trust can't distribute a loss, therefore the loss stays within the trust structure. If we have a net profit, the profit is distributed to the beneficiaries firstly, according to how the trustee's wishes are for that distribution to occur. And then if there's any income left over at the end, after we've done our distributions, that belongs to the trustee who was taxed at the trustee's rates. So you can see up here, there's 3 steps. Always simplify it for yourself. Take the fact that the first step is I must find the trust income. What is its income? What is its deductions? Same as we've done for every other topic to date, looking at the income rules, looking at the expenditure rules. Secondly, distribute to your beneficiaries. Read the information that's provided. Well, how does the trustee want to distribute that income? The third step is if the trustee hasn't distributed all his income, he's going to pay tax on it. So stick to the 3 steps, do them 1, 2, and 3, and at least make it a little bit easier of understanding. So in the example 8 we're going to do, where we've got the Chang family trust, it tells us it commenced in the 1996 year, and it was settled by a family friend. Now, in the current year, the income was the net trading income of $40,000, so it's a trading business. It's got unfranked dividends, and it has interest. So it tells you there quickly what the income of the trust is. So if we go to step 1, we can write that up. So step 1, trust income. And we have the trading income. We have the unfranked dividends. And we have the bank interest. So we have $40,000 here, $20,000 here, and $30,000. Oops, sorry. So 40, 20, and bank interest of 30. So you have net trust income of $90,000. So it is this trust income that we must distribute according to how the trustee has advised us. Now, whilst this is a simple form of income, there's no expenditure there, my main concern for today is getting across the taxing of the beneficiaries and the balance left for the trustee. That's why I've chosen a question like this. But just remember, should the question be more detailed and give you a whole heap of income and a whole heap of expenses, just do it the same as we've been doing before. Also remembering that for a trust situation, that the capital gain, if the trust had some capital gains or it had some franking credits attached to franked dividends, those 2 forms of income, so capital gains tax and franked dividends with the dividend credits, must be given to specific beneficiaries. That is called our Division 6E specified trust distributions to named beneficiaries receiving that income. In this case, we don't have that form of income, but just remember, if you did, you would have a few extra steps down here to take away from the net income, the capital gains, the dividends of franking credits, and then you'll be left with a balance. The balance that we distribute must equal this net income, either to the beneficiaries or the trustee paying the tax on the difference. The only difference when we have those other two forms of income is that we give that income to a beneficiary first before we start giving the balance away. There's a heap of questions and you always have the answers in regards to being able to follow that on. So we were told in the question how the trustee wished to be able to distribute this income to those in his trust. It said that the trust deed required the trustee to distribute $40,000 to the eldest daughter, Yim Song, who was 25 years of age and had no other income than that of the trust distribution. So let's have a look at Yim Song. So we're up to step 2 here. We're looking at distributing to the beneficiary. So we have the daughter. Yim Song. Now we've been teaching you to ask questions. The first one is the daughter presently entitled? Now, presently entitled means that you're entitled to that distribution no matter what. Nobody can stop you from receiving that distribution. And in this case, yes, the trust deed says that she is to receive $40,000 of the trustee's income. So she is presently entitled, yes. Is she under a legal disability? In this unit, we've taught you that the only legal disability that we are going to deal with is if she's a minor. And a minor is a person who is under the age of 18 on the 30th of June of the current financial year. We are told she is 25 years of age, so she is not a minor, therefore she is not subject to a legal disability. What section number are we going to tax her under? We've told you. Section 97, not Section 98, Section 99 or 99A. Section 98 refers to a taxpayer who is presently entitled and under no legal disability. Section 98 is in regards to a beneficiary who is presently entitled but is under a legal disability, and Section 99 and 99A relate to the distribution of the balance being paid to the trustee and the trustee paying tax on. So in this case, she is Section 98 because we can say she's presently entitled, no legal disability, taxing, is 97. Who is liable for the tax here? Well, she's not under any legal disability, so she pays her own tax. So in regards to the liability of the person subject to the tax, it is Yim. What rates will we use? The rates we would use would be ordinary rates because she's being taxed as an ordinary taxpayer because of her age. So we would use the ordinary tax applicable. How much is she? What is her trust distribution? Well, she received $40,000 as her trust distribution. So in a question, you must always write this out because it helps you decide what section she'll be taxed under, what rates they'll be taxed under, how much they've received. When we're marking in the final exam, you will be required to provide this detail. And if you don't do it, you lose valuable marks. You would have had to have asked yourself all these questions anyway in order to work out how am I going to tax them. So you just write them down. Okay, so remember, this is worth marks in a final exam of writing that down. So we know that for Yim, her taxable income is $40,000. She doesn't have any other income. The tax on that, so the tax is equal to $4,547 plus Medicare levy. So the Medicare levy is 2% of taxable income, $40,000, so $8,800. At this point, we have 5,347. What rebates can we take away? Well, we could have the low to medium income tax offset of $290. Because that is the low middle income tax offset is based on taxable income. So you would go to the back of your books, look at your tables and say, okay, does she fit in order to basically get the low medium income tax offset? In this case, we say yes. So we calculated according to the formula and she's entitled to $290. What about the low income tax offset? Again, $40,000 will give her a low income tax offset of $400. An SBE. Yes, those dreaded SBE tax discount offsets are here because we have trading income. She received the trading income of $40,000, didn't she? So if we were to do our SBE tax offset, the offset is going to be equivalent to 8% of her basic income. So here, 8% will equal your here, which will be $363.76. You can see in the actual answer when you look at it on the blackboard that I have written the steps out for the SBE calculation, but I'm not going to do it here today. But as I said, she received $40,000 income. That has come from trading income. We are told that the trust is an SBE trading entity. Therefore, she can have the tax offset. So in regards to that, I need to go up to one. We will end up with all of her rebates equaling $763.76. Her tax position, tax payable, will be $4,583.24. So that's what you have to do in regards to this beneficiary, Yim Sung. The next one we were told of the remaining income. So the remaining income is unfranked dividends and interest, which equal $50,000. 50% was accumulated for the eldest son until he reached the age of 21. The trustee has discretion to pay for his trustee out of his share. He was 15 years of age at present, and in the event before he turns 21, he passes away, his account, let's call it trustee beneficiary account, will be paid to a charity. And he earned $8,000 from a job during his school holidays. So again, we need to take that information and start with this portion here to work out how we're actually going to tax this beneficiary. Sorry, I'm going to lose a piece of paper. So the son. So is he presently entitled? Now, presently entitled means that you have a legal call on the money that is provided to you. We are told, so the legal present entitlement, we have to say, what happens to the son's entitlement should he die? In this case, we're told that if he dies before reaching the age of 21, which is his entitlement age, anything that is accumulated to him in the trust prior to that will be given to a charity. So he does not have control over that income or capital. The trustee is controlling it till he's 21. Even if he should die before reaching 21, the trustee still controls it. Therefore, he is not presently entitled to 50% of the income. But he is presently entitled to a certain amount, the amount that the trustee has paid for his education. So remember under Section 101, when a trustee pays an expense out for a beneficiary, it is deemed to be a present entitlement under Section 101. So due to the fact he has no control over 50% of the income that the trustee is giving him, he does not have to pay tax on that because he has no control. He is, by definition of Section 101, presently entitled to the $12,000 that's been paid out on his behalf. So it is this amount here that we are going to bring in as the income from the trustee. We will then ask, is he under legal disability? Well, yes, he's a minor. We're told he's 15 years of age, so he's a minor, therefore a legal disability. Now, if you're under a legal disability, the section number that is applied to you is section 98. That means that the person liable for the tax on this $12,000 is the trustee. So the trustee at this point is stepping in as an individual. He is saying, I have given you $12,000. You are a minor, therefore under a legal disability. I now step into your shoes as an individual. I'm no longer a trustee. I am acting for you. So in these cases where the trustee is acting for you under Section 98, they still have to pay Medicare if applicable for you. They would still able to use some of the offsets that might be available to you. And again, remembering these are all based on taxable incomes. They're also based on the source of the income. So in this case, remember that the trustee is liable. What rates are we going to use? Well, we have to ask ourselves, is the son a prescribed person or an accepted person? Remember, being accepted means that you're a double orphan, you're in full-time employment at the 30th of June, and you have no intentions of returning back to school, or you are under a permanent disability which has been signed off by a medical practitioner. In this case, the son doesn't fit any of those characters. He's got basically a part-time job. We're not told if he's a double orphan, and we're not told if he has any illnesses. Therefore, he will be taxed at a prescribed, so we would put prescribed person is 1. So when you're dealing with a minor, you would first look at what type of a minor am I? Am I a prescribed or am I an accepted? Secondly, you have to look at the income. Where does the income come from? Is it from an eligible source or an acceptable source? Acceptable sources are taxed at ordinary rates, so his part-time job, income from a deceased estate would all be ordinary income. If it's accepted income, then it is, eligible income. The eligible income is taxed at Division 6AA rates. Now we are told this is an ordinary family trust. It has this type of income. It trades, it has investments. Therefore, it is not a form of accepted income. It is eligible income that must be taxed at the highest rates. So Division 6AA is 45%. So the trustee is going to pay 45% on the $12,000 that is given to the son. So the taxable income, and this is the trustee, remember. The trustee is doing this, is $12,000. The tax at 45% is $5,400. There is no Medicare because he's less than the threshold. There is no offsets. Because remember, a trustee is not allowed to be given any tax offsets, low income tax offsets or the low middle income tax offset for a minor who does not receive accepted income. Okay? So in this case, the tax by the trustee is going to be $5,400. Now we're also told that the son had a job. So the son has to lodge an income tax return as well. And this is under authority of Section 100 that says if you are a beneficiary receiving income that is taxed under Section 98 by the trustee, if you have any other income, you must lodge your income tax return as well. So the trustee will lodge this, he will get an assessment and he will have to pay $5,400. The son has to do his own tax return under Section 100 and he'll bring to account all the income he's earned, which also includes this $12,000 trustee amount. So the son's income will be $8,000 from his job and it will also be the $12,000 from the trust. So that's his job, that's the trust distribution. So the son has a taxable income of $20,000. But what we have to do at this point also is we have to be able to work out, okay, the trust has given me $12,000 and paid $5,400 tax for me. I've got a job for $8,000, but if I added the two together, my taxable income is $20,000 and I'd be paying tax on the $8,000. What I need to do is work out the tax on each of these individual rates of income or items of income to work out what tax it'll be payable. Remembering that this is eligible income and this is accepted income. Accepted income is at ordinary rates and this is at Division 6AA. Now remembering all of these rates and tables, etc., are in the back of your book. You need to use them. There's a tables for 98, 99 rates. 97 is just the ordinary rates of tax. You'll also note in the topic of minors and trust, there was 2 flow charts that helped you work out the flow of what is different forms of eligible and accepted income, a prescribed and eligible taxpayer or accepted taxpayer. Those tables, flowcharts, will also be provided in your final exam. They have all these rates on them. They have all these divisions. So it's not necessarily that you spend all this time tabbing your books for these. Learn how to use the flowcharts is my tip to you. So in here we know the ordinary rate on 8,000 is 0. The tax on this is at 45%, so 5,400. Okay, so you end up with tax here of 4,500. What happens in regards to Medicare? Well, there is no Medicare because we're less than the threshold. So that's our tax. Medicare is 0. Offsets 0 because we're not entitled to any. But a new credit we have to bring in is the trustee's credit. So the trustee has paid already 5,400 for us over here. So we're entitled to a credit for the tax already paid for us. Therefore, the tax will be 0 that we have to pay personally. Even though we still have to pay, we don't pay any tax, we still have to lodge a return because we had other income. So always please remember, and it's one of the nightmares of marking when you can see the students, forget one of these steps. They either give all of this to the trustee or they give all of the income to the beneficiary to deal with. It comes in 2 steps. 1 is the trustee. 2 is the taxpayer themselves if they have other income. So please, please remember, if you're using Section 98, they have other forms of income. I want 2 calculations. The amount paid by the trustee becomes a credit in the individual's tax return, okay? Oops. Try blue. So let's go back to the question and see what it says. Okay, so we've done his job. The remaining income was to be paid to after the payment, 30% payment to the son. Remembering the son wasn't entitled to it. So it was to be accumulated for another daughter, 14, until she turned 21. Again, so we have another daughter. Okay. Yim. Now Yim is 14. Presently entitled. Well, did we give her anything? So it says after the payment, the remaining income was to be accumulated for the daughter. But she's 14 years of age, 14 years of age. The trustee has paid nothing out for her at all. So she's not presently entitled to anything. So because she's not presently entitled to anything, that's the end of her. Okay? She's not present. Why is she not presently entitled? Because if she dies before reaching her entitlement age, it goes to the other beneficiaries. So her share of the incomes and profits would go to all the other beneficiaries. So she's not presently entitled. She has no control over that. If it said that it went to her estate, so it went into her estate to be dealt with, then she would be presently entitled. But because she can't even say what happens to it when she passes away, she has no control over it whatsoever. So it brings us to the last one, who is Yim. Yim is a cousin of the family. So he is their cousin. Again, we say, is he presently entitled? Let's read it. So he's entitled to 10% of the income, and 10% was to be paid to him, and he's orphaned, okay? He's orphaned. The cousin qualifies for the double orphan, but for Section 1003 of the Social Security Act of 1991. So they get 10%. So let's have a look if the cousin is presently entitled. Yes, because it doesn't say anything to the contrary that is not. Under a legal disability? Yes, because he's only, how old is the cousin? The cousin is only 12 years of age, so under legal disability. Cause of legal disability, trustee steps in, so Section 98 will be our taxing regime. Liable person is the trustee. Trustee is always liable under Section 98. Just remember these little tips and it'll make the answering of the questions good. Rate. Okay, is the taxpayer a prescribed taxpayer or an accepted taxpayer? An accepted taxpayer, as I said, is a double orphan. Somebody with full-time employment at the 30th of June and no intentions of reschooling, and under a medical condition. In this case, you were told we have a double orphan, so they are an accepted person. Accepted means that you pay tax at ordinary rates. When you're an accepted person as a minor, it doesn't matter where the income comes from. It could come from a business trust. So he could have received 40%, his 10% built out of that. It doesn't matter. Accepted taxpayer always gives you an ordinary rate. You don't need to look any further to the source of the income. The amount he got was $5,000. The trustee steps in, so taxable income for the trustee, $5,000, tax at ordinary, 0. Medicare, 0 under the threshold, low income tax offset, low middle income tax offset, all 0 because he's got no tax to pay. So the trustee pays 0 tax. In this case, the cousin doesn't have any other forms of income. So there's no need at all to do step 2 like we did in regards to the son. I'm going to change colors again. So we get to a point now where we can say, okay, we've done step 1, we've done that here, we've done step 2, we've done all of the work here, we've done the daughter, the son, the other daughter, the cousin, but we still got some income left because we had 90 grand, we gave Yim 40, we gave the son 12. We gave the cousin 5. Remembering the other daughter got nothing because she wasn't entitled. So you end up with a balance here of $33,000 left. So we've got this undistributed $33,000. Trustee pays tax on it. Trustee will have Section 99 or 99A, depending on what type of a trust it is. A deceased estate is taxed at Section 99. A family trust, a discretionary trust, or a trust that is from the living is taxed at Section 99A. So the section is 99A. It is at 45%. So the trustee is going to have to pay $14,850 is tax payable. So the trustee is not a person here. He was a person when he stepped into the shoes of the beneficiaries, but over here he is not a person. He is a trustee of a trust. No Medicare, because that only applies to individuals. No low income tax offsets. No low medium income tax offsets. No SBE tax offsets, because they're only available to individuals. Remember, these are only available to individuals. The trustee is not an individual over here. Therefore, he doesn't get any offsets, doesn't pay Medicare or anything like that. So, what do we take out of this? 3 steps. Doesn't matter how difficult step 1 is, we're still just going to do income less deductions equals net trust income. Once you get that, if you've got capital gains, franking dividends and franking credits, take them out, work out who's getting them, take it away from the total income. The balance is what gets distributed to other beneficiaries. Step 2, you've worked out the income. Start working out how it's going to be distributed. This is very important in order to fill in to get marks, but also to help go further into how I'm going to tax, what I'm going to tax, what rate shall I do. Always remember that when the trustee steps into somebody's shoes, he is a person, individual, can get the Medicares, the rebates, etc. If the beneficiaries have other income under Section 98, you do 2 steps. Trustee pays his tax on the trust distribution only, then the beneficiary pays tax on all their income, including from what was given to them in step 1. When you have a minor in regards to the income, always make sure you're asking yourselves, are they a prescribed taxpayer or accepted? If they are prescribed, what type of income are they receiving? Is it eligible or is it accepted income? That will determine what rates you use to pay for the taxpayer. Now the question did go on and ask us to consider what would happen should we change it to a deceased estate. So somebody has died, and rather than it being a living trust, it's what we call a deceased estates trust. What happens in regards to that? In regards to, well, nothing for step 1. We still would work it out the same. Step 2, how do we look at we still distribute. For the daughter, she was Section 98, so no change. So no change for B here. In regards to the son, the trustee was paying tax, but here is where we change. A deceased estate is an accepted form of income. It would be taxed now at ordinary rates, okay? So in this case, a deceased estate will be a form of ordinary income. The taxpayer himself is still prescribed, but when we look at the income comes from a deceased estate, so it is taxed at ordinary rates. So here, the tax on $12,000 at ordinary rates would be 0 and 0. Over here, again, this would be at ordinary rates. The tax would be 0, 0, 0. No credits because we've got 0 here, and we end up with 0. Okay. The cousin themselves, the daughter would be no change, so no change. The cousin is no change because they are already being taxed at accepted income, okay, because they're a double orphan. It's already at the ordinary rates of tax anyway, okay. Here, the trustee, what happens to the trustee? Well, the trustee is now taxed at Section 99 at ordinary rates. So the tax for the trustee here would be $2,812. So what you take away from trust is read the question. Find out firstly, what sort of trust am I dealing with? Because if it's a deceased estate, it's easy. Everything's ordinary, okay? If it's not a deceased estate, so an inter vivos, which we know is a family trust, a discretionary trust, you have to look at the tables, work out the sections of taxing compared to the beneficiaries receiving the income, look at the trustees' rates of tax. And as I said, everything is contained in the rates and tables book, and you have those 2 flow charts that will be provided. Learn the flow charts. They will make answering the question in a final exam much easier if you know how to follow those flow charts, pick up the section numbers, etc. So that's going to bring us to the end of the trust and minors question. Any issues, as always, please feel free to email me, post on the blackboard. As I said, trust is a difficult one to get your mind around. So we're here to help you in regards to making sure you've got it nailed before you do your final exam. So thanks very much, and I'll see you next week.